Welcome to another Infographic Instant with Brian Michael. In this episode, we're going to be asking whether shadow banking is a method of reaching for yield in emerging markets. So, to motivate our discussion, imagine that you're standing in the center of Moscow looking at relative yields between the Moscow stock market and between what you might get paid in a bank account. And so you're scratching your head saying, should I put my money in the stock market? Should I put it in a bank? Or should I give my money to a friend who's just offered me the possibility to buy something called securitized tranches for lending in Moscow construction companies? That all sounds very fancy, but what it means is that you're basically buying bundles of loans that have been resold to investors like you in the hopes that you'll buy them in order to get higher return on your overall portfolio. Now, those of you who have been listening to our discussion so far will know that this ties into our discussion of complementarity and substitutability between shadow banking and securitization in general, and other types of financial markets. In this infographic, we're going to be looking specifically at that substitutability and complementarity between shadow banking and the stock market and bank lending. And so to motivate our discussion, let's start by understanding the axes on the infographic you see in front of you. On the x-axis, we plot the correlation with bank lending rates. So this looks at the extent to which shadow banking expands as lending rates rise in the emerging markets you see in front of you. On the y-axis, we see the extent to which shadow banking increases as returns in the domestic stock market increase. So one way of looking at this chart might be to say that, well, as returns to the stock market and as bank loans increase, we might see a decrease in shadow banking because investors would put their money in these more traditional routes rather than shadow banking. Or, of course, if you believe in the complementarity view, you would say, well, no, in fact, investors would put more money in because of generally booming financial markets, because rates of return are rising everywhere. That suggests that the investment climate is good. And like we've shown in the previous infographics, the story is different depending on the country that you look at. So in the case of India, for example, we find that shadow banking volumes increase as the stock market performs better, but decrease as lending rates rise in India. In Argentina, the story is different, as shadow banking decreases as the stock market has traditionally done better and as banks have traditionally paid more. In countries like South Africa, Indonesia, Mexico, and Brazil, we see that shadow banking has tended to increase as bank lending rates rise. However, shadow banking has increased as returns to the stock market has decreased. And finally, for countries like Russia, Singapore, and Chile, we've seen that the volume of shadow banking has increased as returns to both the stock market and the amount given by banks to passbook account holders has increased. So, of course, it's not our function to explain the data here. Our main objective is to understand that these are relationships that, if they continue into the future, can help shadow bankers identify which would be the attractive markets given what they see the stock market, given what they see interest rates doing every time they open the local newspaper. So the broader message, of course, is that securitization, and specifically lending from non-bank financial institutions, is just another part of an overall balanced portfolio, and in countries such as Russia, we can expect increases in shadow banking activity as a proportion of overall financial activity as we see the local stock market and as we see local interest rates rise. This has been another Infographic Instant with Brian Michael.